Welcome to the Golden IOU, a visual guide to understanding bonds. This video will show you how lending money can become a strategic investment tool. A bond is essentially a fancy loan. When you lend money to a government or corporation, it's an investment. By buying a bond, you are buying debt. You become the bank, making it a fixed income investment. Let's look at the anatomy of the bond contract. The face value, or par value, is the principal amount you get back at the bond's expiration, which is the maturity date. The coupon rate is the annual interest the borrower pays you. Bonds are issued by different borrowers. Treasuries are issued by the U.S. federal government. Municipal bonds, or munis, are issued by states, cities, and counties, often offering tax-free income. Corporate bonds are issued by companies, offering higher interest rates, but with higher risk. The trust scale measures risk versus reward. Investment-grade bonds, AAA, AA, are low risk, but offer low interest payments. High-yield or junk bonds, B, C, D, are high risk and must pay more to borrow your money. The relationship between bond prices and interest rates is like a seesaw. When market rates go up, the price of existing bonds goes down. Conversely, when market rates drop, the price of existing bonds goes up. This price change is due to competition. If your old bond pays a higher coupon than new market bonds, it is more valuable. The market adjusts the price of your bond so the yield matches the current environment. Yield to maturity, or YTM, is the true return if you hold the bond until it expires. It calculates the total return by factoring in regular interest payments and any gain or loss from the price paid. Sensitivity, or duration, measures how much the price will swing due to interest rate changes. Short-duration bonds have low risk. Long-term bonds, those with longer maturity and lower coupons, have the highest sensitivity and risk. There are different bond flavors. Zero-coupon bonds are bought at a discount and pay no interest. Callable bonds can be repaid early by the borrower. Puttable bonds give you the right to sell them early. Convertible bonds can be swapped for stock. You can enter the market through individual bonds or bond funds and ETFs. Individual bonds offer control over maturity and principal guarantees if held to the end. Bond funds and ETFs offer instant diversification, but prices fluctuate and there is no fixed maturity date. Stocks versus bonds. Stocks are equities, serving as a growth engine with high volatility where you are an owner. Bonds are fixed income, offering a safety net and income, with risk from interest rates and inflation, where you are a lender. The beginner's checklist covers 5 rules of thumb. Check the rating, look at YTM, mind the maturity, watch the rates, and diversify. These checks help ensure a sound investment strategy. This cheat sheet summarizes key terms: issuer, principal par, coupon, maturity, default, and duration. Bonds are the bedrock of the global financial system, and now you understand how the foundation is built.